All right, in this lesson we're going to talk about accounting structures and auditing firm structures, continuing our understanding of accounting firms and understanding of how they operate at the end of the day. Now, in this lesson, we're going to be talking about the structure itself, how they organize as a structure for corporation purposes, and then we're going to talk about internally how they are put together from a personnel standpoint. Now, this is an important lesson because I've talked to a lot of CPA managers, CPA firm owners and partners, and they're always surprised by sometimes my students because they understand the structure of an organization for auditing. And it's really no different than any other structure, but there is a progressive ladder, and when you understand that, you really set the expectations not only on yourself, but that firm owner, that you understand what it takes to get to the top, and it's not going to be a quick flip of the switch that you start at the entry level and then you get to the top in like 3 to 5 years. Okay, so understanding the latter part of this lesson is important when you go into interviewing and they ask you, what do you want to do in our firm? And you start off, well, I want to start with staff, and then about 3 to 5 years you get to senior, and then you get to manager, and you have an understanding of how the firm operates. It puts you on a different level than your peers who may not know. So let's get started really quick here with the organization's legal structure. So there's multiple legal structures that you can actually incorporate in. We're going to talk about 3 of the major ones. The first one is proprietorship. This is a lower barrier of entry option, but it is hard to comply with regulatory requirements. And what we mean by proprietorship, they pretty much own their own business. They're not a corporation. They're not a partnership. They file a DBA in some states. This is based on state law. Some states require you to file a DBA, some don't. But you're basically in your business yourself, small mom and pop, doing audits. Now, this is hard because you may not have the resources as a small mom and pop to accomplish it, or a proprietorship to accomplishment. In addition, with a proprietorship, you're leaving yourself open to personal liability if you do something wrong within an audit. An audit is one of those high-risk services that accountants sometimes provides, okay? Corporations is another option. The problem with corporations is they're big and bulky. They do have a tax disadvantage because they would be considered a professional corporation and subject to a higher flat rate percentage. Some states do not allow professional service organizations to be corporations. So if you are in a certain state that doesn't allow professional services like accountants to be a corporation, then you will not be able to file as a corporation or incorporate as a corporation. Okay? And then the last one that we have is general or limited liability partnership in corporations. The nice thing about these ones, they're more nimble. They allow for some type of protection, not absolute protection. The nice thing about a corporation is that when they get sued, their owners are not financially responsible other than the amount they've invested into their corporation. So if the corporation doesn't have the money to pay, the corporation goes bankrupt, and the owners, whatever cash that they have in their personal asset or their homes and assets, are not affected by the bankruptcy of the corporation. Not such the case with a limited liability partnership or corporation, not so the case with a general or a limited liability partnership or corporation in particular, and we'll go over the particulars in a minute. Okay, they are more nimble. They don't have to follow the strictness of a corporation. They have the free flowing of a proprietorship, but they have the limited liability as that of a corporation. Okay, so again, allows for some protection. Now, what do we mean by that? Well, let's talk about this first. Many firms like to be LLPs because they can't be corporations. They don't want to be proprietorships. What they're left with is an LLP. Now, they can't be an LLC because of the same issues here with corporations. Can't be a corporation, so you can't be a limited liability corporation. Okay? And a lot of them avoid general partnerships because general partnerships would imply that there would be no legal liability protection for those general partners. Okay? So most audit companies like to be LLPs because it provides a greater personal protection from lawsuits. So if a lawsuit happens to the LLP, they're not necessarily responsible for it. So if the LLP goes bankrupt, they're not responsible for financing the things that are owed to the person that sued them. In addition, partners are not personally responsible for liabilities arising from other partners and most employee negligent acts. So what we mean there is, here's the weird thing about LLPs. If you commit a negligent act as part of the LLP's assets are not protected anymore, nor is your personal assets protected, okay? Because you are committing that negligent act, okay? Now, let's say someone sues the LLP, but it's not because of your negligent act, it's because of another partner's negligent act. If that's the case, they could sue the LLP and that partner personally, but they can't sue the rest of the partners because of the limited liability protection. So basically what we're saying is if you're sued, if the LLP is sued, they can sue the LLP and the partner that or owner that committed the negligent act or their supervision of the negligent act. But all the other partners are free from personal liability. They're still liable from a LLP standpoint, so they're going to lose everything on the LLP like they would a corporation, but they wouldn't lose everything personally because the lawsuit cannot be held personally liable from the lawsuit because they didn't commit the negligent act, okay? So when we say partners are not personally responsible for liabilities arising from other partners, so if another partner commits a negligent act, I'm not personally responsible for it. Now, I am partnership responsible for it because I own part of the partnership, but I'm not personal, so they can't come on my personal asset. If I commit a negligent act, then the client can sue the partnership and me directly, personally, to recoup any monies that they've lost, and therefore my assets are now not protected. What does that mean? If the judgment is against me for $500,000 and my home is worth $500,000, theoretically I would have to sell the house in order to pay that $500,000 lawsuit, even though it was because of the act that I did as part of the owner of the organization or the LLP. So again, it doesn't provide absolute limited liability protection, but it does allow for a good substantial amount of it, okay? I know we spent a lot here. Let's go over here now. Classification of firms, we have the Big Four. So the Big Four is our Big Four international accounting firms. Those are Ernst & Young, EY, PricewaterhouseCoopers, PwC, Deloitte & Touche, and then KPMG. So those are the Big Four. Those are the Big Four, the biggest four revenues of all the audit firms in the world. Okay, so those are called the Big Four. They used to be the Big Five and then the Big Six and the Big Eight, all of that. If you've been in this for a long while, you know them as the Big Eight or the Big Six, but now we're down to four, the final four in the audit profession. Then below them we have national firms. These national firms or mid-tier firms may have international operations or they may have international affiliations, and what that means is they operate here in the United States and then they have an affiliate that has the same name that operates around the world. That way, whatever limited liability, whatever legal trouble they get into doesn't affect the legal trouble financially here in the United States, although it might tarnish their reputation, so then there's another issue there. Examples of national firms would be Grant Thornton, RSM McGladrey, and BDO Seidman. So those are mid-tier firms, so they're just a step below. They don't have as much revenues as these top four, but they do a fair number of audits, they do a fair number of taxes, they do a fair number of consulting. Now, below them, we have a regional and local firms, and I didn't want to separate them, but regional and local firms would be firms that operate within a region or a specialty. Local firms would be even smaller than regional firms. Maybe they only work in a city or a town or an area. But these firms also provide quality service. Maybe they're tailored to a specific industry that these people are not. Here in the Midwest, I have a lot of auditing firms that work with farmers and agriculture, and so that's their specialty. They're regionally located, which means they're regionally located here in the Midwest. Or in places in the United States where there are farms, but no, not in the big city, okay? Regional local firms. So that's classification of firms. Now, within a firm, we have a classification of personnel. Now, before I talk about this classification, I do want you to know that this may be different between firm to firm. So a small local firm that has 5 employees may not have this structure in place. A firm that is the Big Four or a national firm does have something very similar to this, but they may call it different things, okay? So I'm going to walk you through the general idea, knowing that when you go to different firms, this may need to be tailored a little bit. So we've got our staff and associate. Staff and associate usually has 1 or 2 years of experience in the industry. When you first start with an auditing firm or in a tax firm, you'd be considered a staff or an associate. Then from there, the following year, you would be called a semi-associate. So this is year 2/3. So you are a semi-associate. So you're not necessarily in charge of the audit. You're still probably doing some of the same stuff you did as a staff or an associate, but you're given a little bit more responsibility, a little bit more of the harder work than the staff or an associate. Okay. So staff and associate. Then we have semi. Now, depending on the firm, this is year 3. Sometimes it's year 2, but typically year 3 or beyond. This is the senior. They're the one in charge of an audit. Okay, they're the ones in charge of the daily operations of the audit. What that means is these 3 right here typically only are assigned to a client at a time and not multiple clients at a time. And again, this varies by firm to firm, but at the Big Four level, typically if you're a staff, you're associated to 1 client at a time. Same thing with semi and then senior as well. Now you might be rolling off one engagement, going to another, and so because of that, you are on multiple clients, but generally speaking, it's 1 at a time. Senior is responsible or the in charge, 3 years. Some firms, you're a senior if you have your CPA, you're an in charge if you don't have a CPA, which means you're not given senior privileges, but you still have to do senior level work. From there, within about 5 to 6 years, depending on the organization, so you're here at year 3 to 4 years later, you become a manager. Manager manages multiple seniors. And so a manager is giving basically a portfolio of clients, and they manage those projects or those jobs or those engagement teams all at the same time. Depending on the workload of that manager or depending on the clients that manager has, it could be anywhere from 1 client to multiple clients. The bigger the client, the less other clients are going to have at one given time. So you may have a manager that's overseeing a huge audit, then that manager is going to be assigned to that audit. Okay, but you're going to have smaller audits in which can get done by the senior and below, and so that manager just goes from one place to another, and maybe you only see them once every other week or once a week in the office or at your client's site. So managers oversee all of this, and these two work together all the time because the senior usually doesn't know what's going on. The manager does, so the manager is helping the senior understand what's going on. Now, at the manager level, some organizations have something called the senior manager, which is just more experience, between 8 and 10 years, more experience than the manager, not necessarily in the details of each engagement. Maybe they're a little bit hands off, but their responsibility is maybe client relationships and retention, and maybe business development, creating more clients in the pipeline. So these people are getting ready to become partner principals or directors. And so kind of leaving off a little bit off the engagement, but more about how to become a better leader so that they can take on the role as principal, partner, and directors. Principal, partners, and directors, these are the top people in the organization. Partners and principals would be considered owners of the organization. So they own a part of the firm, and you might go, how do they own it? They actually do own it. They buy into it and own it. Directors, on the other hand, at some organizations are non-owners. So you have owners and non-owners. Some organizations will call partners owners and principals non-owners. So it just depends on the lingo and the language of the organization, but you have owners and non-owners. Non-owners are individuals that maybe don't care about the ownership, but they're very technical in their skill set. And so they still want to do what they're doing, but they don't really want to be owners. They just want the guaranteed salary. That is a director, versus this is a partner who actually owns, is responsible for business development and the engagement as well. So again, these people pretty much do the same thing. It's just, do you want to be an owner or not? And if you're not going to be an owner, you're going to get paid a little less or a lot less, and you're going to do the same type of work as the partner does. So again, different things for different people, or different things for different firms at the end of the day, but that's the rank. So 1 to 2 years, 2 to 3, 3 to 5, 5 to 8, 8 to 10 or 12, 12 to 13, and then partners 13 years, 12 to 13 years or above. Some say it's 10 years, just depends on the firm. Some say it's 5 years. I know smaller firms where it's staff, senior, partner, or staff, partner. Okay, just depending on how the organization works at the end of the day. So this is an overview, a long overview of an accounting firm and how these accounting firms work at the end of the day. Hey, thanks for watching my video. If you like what you saw, make sure you press the thumbs up button that's right below here. If you have any questions, make sure that you leave a comment or that question in the comment box below. And if you haven't subscribed yet, make sure you press the subscribe button. It's just below me. Hey, if you want more videos like this, make sure you go to www.patrickleemsa.com to see more videos like this, or if you just want to learn more about accounting. Thanks for watching. We'll see you in the next video.